As of midday trading on June 2, 2026, the live intraday price of SoFi Technologies Inc. stands at $17.97, representing a 3.31% drop on the session, with total daily volume hitting over 32 million shares, as selling pressure accelerates from the morning bell. While the crowd treats this midday slide as another standard blip in the volatile fintech landscape, the hidden story dominating the tape is institutional positioning. Large fund managers are using today's pullback to build options blocks, signaling that behind the screen, Wall Street views this technical floor around $18 as a crucial accumulation zone. Retail traders look at the raw drop and worry about short-term momentum, but the true underlying activity suggests a major decoupling between near-term panic and long-term capital allocation. The baseline expectation for SoFi stock has always been centered on its status as a high-growth disruptor, trying to win the digital banking war against legacy giants. Investors look at their screens and assume that because the company consistently reports record member acquisition numbers, the equity price should naturally appreciate in a straight line. The market baseline suggests that a digital bank targeting high-earning young professionals will find an easy path to profitability by cross-selling high-margin insurance, brokerage services, and wealth management tools. People look at the sleek interface, look at the quarterly user growth metrics, and expect a smooth growth asset that should trade at a premium to standard regional banking corporations. The reality, however, is far more complicated and introduces a significant tension for anyone looking to invest online. Despite pulling in massive numbers of checking and savings accounts, the core profit machine remains deeply tethered to macroscopic credit environments, interest rate cycles, and capital adequacy requirements. While the retail community celebrates top-line expansion, the institutional reality is that originations in their core personal and student loan books have faced persistent structural bottlenecks due to the higher-for-longer rate environment. This gap between retail hype and balance sheet reality is precisely why the stock experiences sharp, sudden pullbacks even after positive headline announcements. It forces a fundamental rethinking of what this business actually is, proving that it cannot yet shake off the gravity of traditional banking physics. When you look closely at recent stock movement, the daily swings paint a vivid picture of a market trying to price a hybrid business. Over the last month, we have seen massive volatility spikes, with trading volumes regularly exceeding 70 million shares on negative macroeconomic prints, followed by quiet consolidation windows where the equity drifts lower. Institutional activity has shifted towards systemic accumulation via structured derivatives rather than direct spot market purchasing, meaning massive blocks are moving under the radar without causing the immediate upward price action retail hopes to see. This subtle institutional migration is happening because big money wants to mitigate the risk of high interest rates eating into the net interest margins that underpin the financial sector. Recent earnings reactions showcase this exact friction between expectation and reality. When the company dropped its latest quarterly report showing strong revenue numbers, the stock initially surged before being rapidly sold off by institutional desks who noticed a slight slowdown in the technology platform division. The market is punishing any perceived weakness in non-lending revenue streams because investors want reassurance that this business is a tech firm, not just a bank with a great mobile experience. Sector momentum has also shifted, with capital rotating away from speculative growth names toward defensive financial vehicles like short-duration Fidelity ETFs, creating an artificial drag on the entire consumer fintech space, regardless of individual company execution. Macroeconomic pressures continue to dictate the daily bounds of the trading chart. Stubborn core inflation data and shifting treasury yields have forced self-investing accounts to reconsider their risk tolerance, which directly impacts asset allocation in modern investing sites. When institutional desks see credit delinquency rates ticking up slightly across the broader middle-class consumer demographic, they automatically de-risk their individual brokerage exposure to names that focus heavily on personal unsecured lending. This systematic selling has kept the equity pinned below its historical highs, showing that no matter how fast a digital platform signs up members, it cannot entirely insulate itself from the realities of Federal Reserve monetary policy and systemic credit cycles. Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you prefer keeping your capital in more traditional institutions. To truly understand why the stock behaves this way, we have to look closely at what the underlying company actually does and how its core business model operates. Fundamentally, this is a three-pronged business consisting of a consumer lending arm, a financial services division, and a technology infrastructure layer known as Galileo and Technisys. The lending segment provides personal loans, student loan refinancing, and home mortgages, serving as the traditional engine of profitability by collecting interest income on held assets. The financial services wing acts as a digital supermarket, offering high-yield checking and savings deposits, automated wealth advisory programs similar to Schwab Intelligent Portfolios, and self-directed equity trading. Finally, their technology infrastructure sector acts as a back-end engine for other global fintech programs, processing card transactions and hosting digital banking ledgers for external brands. Historically, the business model relied almost entirely on refinancing high-interest student debt for young affluent graduates, a strategy that generated immense early cash flow, but was severely disrupted during the multi-year federal student loan payment pause.
That past performance bottleneck forced management to aggressively pivot toward personal loans to bridge the revenue gap, a move that successfully sustained growth metrics but significantly altered the risk profile of the balance sheet. Past reports from previous financial years show a clear trend of massive marketing spend used to buy market share, leading to high customer acquisition costs that took years to offset. It was only after securing a full national bank charter that the underlying mechanics changed, allowing them to use low-cost customer deposits to fund their loans, rather than relying on expensive warehouse lines of credit from third-party wholesale lenders. Analyzing the competitive landscape reveals how intense the race has become within the online investing and modern wealth management sectors. The company doesn't just compete against traditional regional banks, it faces fierce pressure from dedicated retail trading giants like Fidelity Investments and Interactive Brokers trading platforms, both of which offer advanced analytical capabilities and deep institutional liquidity. For users looking to invest online, alternative destinations like the Robinhood app provide extreme simplicity and fractional shares, while legacy operations like a standard Fidelity brokerage or Interactive Brokers platform pull away older, wealthier account holders. Even the automated wealth space is crowded, with sophisticated offerings like SoFi Robo-Advisor running directly into massive industry benchmarks like the Schwab Intelligent Portfolios ecosystem, forcing companies to continuously on product development just to maintain relevance among modern self-investing demographics. Looking toward the future outlook, several distinct scenarios could play out depending on key catalysts over the coming quarters. In a bullish macro scenario where consumer credit risk stabilizes and the tech platform signs several Tier 1 global banking clients to its Galileo core infrastructure, the business could see a massive margin expansion that forces Wall Street to revalue the equity as a capital-light software company. This transformation would cause the stock to break out of its current banking multiple and re-rate closer to enterprise software valuations. On the other hand, if consumer defaults rise across the industry and deposit growth slows down, the company will be forced to hold more regulatory capital on its books, limiting its lending capacity and depressing return on equity metrics for the foreseeable future. The ultimate reality of this asset is that it remains caught in a structural identity crisis that dictates its market valuation. The general retail expectation is that this business will scale exponentially like a pure-play technology platform, completely upending traditional financial distribution models. The cold reality is that it must operate within the strict boundaries of national banking laws, reserve requirements, and risk management parameters that cannot be bypassed with software. For investors utilizing modern investing sites, managing the stock requires recognizing that while the front-end user experience looks like a frictionless tech company, the back-end economics are fundamentally bound to the classic laws of the financial sector. Success or failure will depend on whether management can scale the non-lending technology segments fast enough to outrun the cyclical drag of their massive consumer credit portfolio. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Unshare with your friends. Bell. Subscribe for more updates.